All right. Good morning, everybody. Sorry, it's a few minutes late. The computer decided it really needed to have an update on something, and it wouldn't let me do anything else until I put that update in. So it goes. So China continues with the reopening and the reduction in COVID zero policy. And yet, as we're going to see through the morning briefing today, it appears to be a little bit of sell the news, because some of those ADRs that we've been watching are actually off a little bit. But I mean, they're up considerably since November. So let's see. China reopened, Wall Street warns, stocks pull back. The Bloomberg's 5 things you need to know talked a little bit about how the China COVID zero reduction is going to very likely affect the crude, and crude something that we've absolutely been focused on. So if you don't get the Bloomberg's 5 things you need to know, it's something you should consider. It's free. They will email it to you every day and doesn't cost you anything. So certainly something to take a look at. And most of the time, I generally already know the things that they talk about, but every once in a while they surprise me. So it's yeah, it's really good. There's another one called Morning Brew, and that is another free one. It's got a little more ads in the email, but it's still a good email. So if you don't have that one, and they also have like Tech Brew, and yeah, they got different branches, all free, certainly worth looking up. And then Tier 1 Alpha is an email that I can't stress enough. If you're trading in the S&P at all, you want that email. It'll have your gamma levels, your volatility levels. Yeah, that's a good one. And all 3 of those are free and very insightful, useful, helpful. We did finally break out of that rising wedge yesterday, and I put out just a little video kind of in providing some insight, not to bow up and get all bared up yet. We don't have follow through. One thing we haven't done in a few days that we want to that I want to get on record is come in and see where the anticipated rate hike probability is at. It hasn't changed much, which is what I expected, which is why we haven't looked at it every day. So right now we're sitting at 375. The anticipated rate hike is 50 basis points, which would put us at 425. We've been seeing this increase over the last month from being a 50-50 chance to being a 75% chance. Seeking Alpha just came out with their free morning thing too. It just hit. So that's over a month. We can see the change, but over the week, we haven't really changed at all. We're just hovering right there. And there's not really expected to be any major change. It's set for the 14th. And usually in the last week, we start getting up into the 80s or the 90%. But until then, sitting at around 75 is fine. So no real change on the December 14th. The February's kind of stalled. They haven't done anything. If you look at what happened from yesterday to today, or from the day before to yesterday, but look at it over the week, how that front end has declined. which would make sense because that would be a suggestion that we were going to go from 425 to 450, which is a 25 basis point rate hike. That's a little unrealistic to believe that they would go with only 150 and then drop us down to a 25. Pricing at a 50 basis points for February makes more sense. And yet it's still sitting at that 50%. It's kind of where we were a month ago. So they want more information before they start messing with the February curve. And I don't come out into these higher curves as much as probably should. We know that that's where the hedge funds are looking, the investors, they, them, those guys, they're all looking farther out on the curve. But it gets to be so much of a hypothetical that to me, it's a waste of my time. Certainly worth taking a look at, though. Continue to look for anything that has Yellen's name on it. I haven't found anything. I'm not, privy to any information that she's going to come out talking. But you want to keep your eye out in case she does come out talking. She's got that agenda for a treasury reset. So when they're in quiet mode, she can speak and not have to share media space. Really light on the econ today. We don't even have additional auctions. We do have a petroleum report at 10:30. This one is worth keeping your eye on. It's important. There are many months that go by where we don't even shrug at that thing, like whatever. And unless you're trying to trade it, you don't care. But we're in a situation globally. We've got an energy situation going on. And with everything going out on the East Coast, this one is definitely worth paying attention to. So 10:30 today, be careful. The consumer credit, we're in a hyper data market right now where every tiny little bit of data is being extra scrutinized. So does the consumer credit have the capacity to rock this market on a day-to-day basis or typically? No. And if you want to kind of get an idea of where I'm developing that idea, how do we know it's going to be that way or not? There's a website called FX Street, and they have an economic calendar. It's got a lot of ads, and it's all up in your face. You don't need to log in. You don't need an account here. They got these pop-ups. So I don't come over here very often, but they do have this impact meter, and this impact meter will kind of look back in the past at economic events that has come out and will gauge what's the anticipation for today. How much does this particular economic event typically cause volatility in the market? So the one that we're looking at, it doesn't have a high expectation of shaking up the market. Looking back at what typically happens. So consumer credit, it's light. It's not this dark one like we have here with the Bank of Canada rate statement. So that's where I get that insight on, what I'm expecting, or it's not like we can remember every one of these. So you got 10 o'clock, 10:30, and 3 o'clock, although the consumer credit really it comes in at power hour anyways. So, one of my personal rules to trading is I generally start to fade out of my positions when I'm day trading as we get closer to the power hour. And unless I'm doing something very specific, I tend to not trade in the power hour. So that one probably wouldn't bother me too much. just a heads up, right? Don't be surprised if the market begins to radically change at 3 o'clock when that news comes out. Volume is within our boundaries. We're looking at the cumulative overnight volume, looking to see if it's really light or really heavy, right? It's like Goldilocks. It's right where it needs to be. We're good. So we just get rid of that thing. We'll look at it again tomorrow. We are inside day breakout. It happened right before I started streaming this morning. This is the range of yesterday. And right now we're presented with a Busby opportunity that it's likely to come back up and test the bottom there against the pivot. Notice, by the way, that we broke right through that pivot. We didn't get a first touch bounce. We didn't negotiate with it at all. It was tag and drop and went right through it. Now, I'm sure if you get on a small enough time frame, you could find where price paused there, but it looks like it just ran right through it. There was no structure at yesterday's low. Keep in mind, liquidity is always on the other side of the pivot. So when you draw a line based on open, high, low, close, or yesterday's levels, or whatever, any kind of language like that, liquidity always exists on the other side of the line. Price is expected to go onto the other side of the line. This is also an H pattern, or it's also a double bottom. And as Investors Business Daily loves to explain, a double bottom is only a really good play when it goes lower than the previous low. If it had stopped right on a dime and bounced, we wouldn't like it as much. The fact that it broke through and then stopped suggests that this could be a bear trap, lets everybody get all bared up right there. And then as it breaks back into the box and begins to run higher, those shorts have to buy back to get out of their position, which adds to the buying, and you get one of those monumental ripping moves to the upside. We don't have that yet, and it doesn't owe us that. It's always a little tricky when you have the double bottom and then the breakdown. Is it really breaking down? Or is it just a bear trap and coming back in? Usually liquidity and order flow will give away some of that information, kind of give you some guidance. Right now we're in an MDP. We're in a missed daily pivot. We have not touched the floor pivot for today. Markets hit that more than 80% of the time. So when it doesn't hit that, it should get your attention. And that's also a strategy. If you were to search on the internet, you would find the MDP trade strategy. I didn't make it. It's not mine. I've certainly thought about making my own, but why reinvent the wheel? I mean, it's already out there. If you're unfamiliar with Thinkorswim, there is a widget called Trade Flash. Trade Flash is part of a service called Hammerstone Markets. And if you really was making a lot of money in trading and you wanted to up your game even more, you could buy this $250 or $300 a month trade service called Hammerstone Markets. They're like an aggregate news source and data provider. And by data, I don't mean like chart data. I mean like information. It's very expensive. It's an actual program that you would install in your computer. It's got logins and all kinds of system mechanics. It's costly. It's a hell of a service, but you get a free glimpse of it if you just turn on your Trade Flash. So as we've seen this move unfolding this morning, if you're looking around wondering, what was that? Look in the Trade Flash and see if they mention any particular reason that it's dumping down like that. I don't see anything in there, but it was worth taking a peek. All right, so we got our double bottom without resolution yet. We've got an MDP, and we are nearing the first ADR. That would be at 39.07. The ADR comes from a 21-day average, how far we have moved from high to low on a day-to-day basis over the last 21 days. Starting from where we opened last night in the Globex, we can go down half of this ADR or up half of that ADR. And the full range between those two would be our entire ADR. So we call this the ADR half. If we looked at that 1.9 and from the close, we measured down the entire ADR, then it would be the ADR full. We went that direction fully, 1.9%, and that would be 38.70, basically. So the ADR half on the upside, which at the moment doesn't look like we're going to use, would be 39.81. And the ADR full to the upside would be 40.19. Breaking out of yesterday's range to the upside, we'd have to get through 40.15. There's a cog line at 40.11. There's also a cog line at 39.30. So we got some pretty respectable pivots to the downside. The full ADR at 38.70 doesn't line up with any of our major pivots. We are outside of the weekly expected move at this point. We tagged it yesterday and managed to get back inside, but we no longer have it. And we got a monthly level at 38.82. Should we get down that far, that's likely to be at least a first touch play. And then I've got a 50% measure at 38.62. So we're on a weekly chart, and we're looking at these past 2 weeks. They were the start of the IX10. We broke out in the third week, didn't keep it. And now we've had our move to the downside, and we are at this very, very critical moment. We're on the bottom of the IX10. In the video that I put out yesterday afternoon, warning people, we're not bearish yet. I know it may feel like we've really taken a turn for the worse, but we're still within the range of the week. We are at the same location we were at a month ago. So we don't want to bow up and aim for the end of the year yet, because we're still inside this box. We got to get out of the box first, and we got to get a candle close out of the box. Now, if we waited for a weekly candle close, we'd be waiting for a lot more days. So let's at least go over to the daily time frame and get a little more insight from that point of view. We need at least a daily close outside of this range. And what that daily close looks like is going to provide a lot of context going forward. We're running out of time. Be careful today of a flip, right? That we get down around the 3,900 and some news comes out in the afternoon that flips everything over and we just rip back to the upside. It's on the table. It can absolutely happen. I don't think that it's going to happen like that, but as I pointed out in the video yesterday, we have a rising wedge and we've broken through that rising wedge to the downside. Now on the week, we also have a rising wedge. So this could be a breakdown where we wick down below that level and we come right back up on a weekly time frame. And I've seen that before, but on a daily chart or on a chart time frame, you could use any of them, 5 minute, 15 minute, whatever. On the chart time frame where you've got a candle close, where you know it's not going to wick down and wick right back in, I can't remember finding a lot of examples where you have a rising wedge with a candle close outside of that wedge, and then it comes back inside again. We also have part of a head and shoulders. And on that head and shoulders, it looks a little cleaner on the SPX. But on that head and shoulders, we still need the other shoulder. So that would imply that we're going to get a rise up to around that 4,000 level. A little bit of a reciprocation play before it dumps. So be prepared for a little trickery. It might want to trap some traders first, causes max pain before it gets its way. Ten-day, 30-minute volume profile. We are back to the bottom of the box. So back here last week when we were at the top and we started talking about where we're at, we mentioned when you're at the top of the box, you have the expectation of going to the bottom of the box. And when you're at the bottom, you expect to go back to the top. Yesterday, the bottom of the box was up here, right? And then of course we had that move down. And now because we've moved down, so has the bottom of the box. If we were to rally today, 39.61 is where the point of control is at, is the most significant level of resistance, and it's unlikely that we would get through there unless the rally today was backed by some really strong news. Say a ceasefire in the Russia-Ukraine war, or China dropping all COVID-0 restrictions, or something significant like that could put us through that level without even slowing down. Possibly some econ, but I think that any petroleum econ would, if it sent us to the upside, would not be enough to just break through in one shot. We'd have to grind our way back through there. Still, we are now not only at the bottom of the box, but outside the box. And when we are outside of the box, the phrase is, well, we're going to get back inside the box. When we break out through the top, the expectation is we'll come back in. When we break out of the bottom, we're going to come back in. We're also now going to be focused on going back to the top of the box. Just keep in mind what I continue to say. Where the top of the box is right now is not where it will be a week from now. That box is not going to stay put. This point of control from Monday, this VPOC, is no longer effective. Just take that off the table. And the one from back here, this 39.60 VPOC that we've been carrying for a while, is no longer effective. Take that one off as well. Yesterday's volume profile with the point of control has already been ran over, so we wouldn't carry that one forward. We do have another one at 37.88. It's a long ways off. We absolutely could reach that, but not likely today, unless things really start to pick up. The dollar is dropping like crazy, and we're going to get to that in a minute, but I want to stress that what we've been using, using that dollar on a day-to-day like we have, we can't do that right now. So, that was really great for months and months. Most of the year, it's been really effective, but don't do it right now. So here we are dropping hard to the downside. And here is the dollar dropping hard to the downside. A month ago, if we had seen the dollar dropping like this, the S&P would have been popping hard to the upside. It would have been an inverse market, like a teeter-totter on a playground. So as I've been stressing now for over a week, they're disconnected again. They decoupled. And that doesn't mean that they can't recouple again, just that for right now, that dichotomy is over. The VIX, on the other hand, is waking up. This thing's been a turd most of the year, almost completely worthless, but it's back. Yay! I've been talking about this also earlier in the week when we were sitting down around $18 or $19, that it would have been a good buy down there. It's still a really sorry hedge. So, if you're looking to protect your portfolio, the only way that this is actually going to protect your portfolio is if we get one of those just market melting, absolute destruction, COVID drop kind of markets. If we don't get that kind of move in the VIX, it's not going to protect your portfolio. But that doesn't mean you can't use it to protect a few trades. And it doesn't mean you can't use it just straight up as a trade, right? When we know that a product is going to move upwards, we can trade into that product and make money on the move up. So at least we have that. It's right now still a gauge that we're using. So we set benchmarks. The VIX below $19 would have been a trigger for the S&P to get above 4,100. And that was on the table. Now it's not. So now we need to focus on what are the ramifications or the effects of the VIX above 22. Well, like I talked about the other day, as long as we're maintaining within this range, we're going to expect the S&P and the NASDAQ to maintain within its range. And it doesn't have to be just straight up perfect, but let's call it 3,800. Might even tighten that up to 3,900. As long as we are sitting inside of these $25 down to, we'll call it 20. If we stay inside of that, we're going to stay inside of this. Should we break above $25 and really begin to accelerate to the upside, then we're going to expect the S&P to also reciprocate in the other direction, breaking down below 3,800 and really getting into this lower, call it the October lows, right? So the VIX has a lot of value to us right now, more value, I would argue, especially now that the dollar has decoupled from the rest of the market. This point of view that I just laid out is not a perfect match, right? I've got a $5 level here in the VIX, and I've got a 300-point spread in the S&P. But I threw this together on the fly. So, when I do some work behind the scenes, get some math and some measurements, I'm very likely going to end up coming out with a video later in the day, maybe this weekend, that has something a little more cement behind it, right? Instead of off the cuff napkin math that I just did here. So this is a good ballpark for now. It's not set in stone. It could be a little higher than that, like 38.5. It could be even all the way up to 39, but I don't think it's that tight. I'm thinking 38.5 or 3,800. Certainly not down to 37. That would be just too much. So we're talking about the split between when the VIX starts to reach past a critical level that the S&P starts to respond to that critical level. Above 25, below 3,800. I'm going to stick with that until I come up with an updated video. The main thing is we're in a channel, and as long as we are there and we're chopping, we're going to expect to stay within this range and chop. It might not feel like chop. Yesterday might not have felt very much like chop. So, there's enough room here to move, and it's still in a range because we're still where we were a month ago. The VVIX, this is the implied volatility of the VIX. Not really, but it's the easiest way to explain what it is that we're looking at. We got down into some really low lows, but we are up out of that, maintaining inside of last month's candle. So we're right where we were. We really want to see this thing get back up to, say 90s, maybe even 100 to kind of reflect that the VIX itself is back and it's alive and it's working. Remember that the VIX is a formula based on volume of options traded in the S&P. When they came up with 5 expirations in a week, all the volume went to the front and nobody was trading 30-day VIX options. Well, if you don't trade 30-day VIX options, then the VIX itself, or if you don't trade 30-day S&P options, the VIX itself won't work correctly. It's a big deal. It's been a big deal all year, and it's kind of breaking all of these different volatility tools. And the VIX just wasn't moving. Well, now it's beginning to move again. And if you look at the volume, and Tier 1 Alpha writes about this in their emails too, they're having a real hard time trying to figure out what to do because our VIX tools just aren't working the way they're supposed to. But all that volume that was in the front is now beginning to spread out a little bit. The analogy that I use is if you were to pour sand or salt onto a table and it starts to build a pyramid, and the pyramid starts to get tall, and then it just can't hold its own weight anymore, and it spills out into a bigger cone or a bigger pyramid. And then as you continue to pour, it builds back up, and then it spills out more. Think of the volume from the front end of the curve as the same way. Once it gets too crowded in the front end, or those front end expires and there's nothing else to get into, the market starts to spread out and reach farther up the curve. If we get back out of nerd mode and just come back into the morning briefing, the VIX is waking up. We can see that it's waking up because this is measuring its movement. If it still wasn't moving, then it wouldn't have volatility. Volatility is increasing in the VIX, implying that we're going to see more VIX movement, which is kind of a good thing. So we're back. Yay. I did a volatility school a few years ago, 20 videos. I swear I could have done another 20 more on top of it. There is so much about the VIX that's worth learning, but I'm a nerd and I like that kind of stuff. You don't have to have it. It just really does help to better understand what's going on. All right, so we're looking at Microsoft. On a monthly chart, we're still in the higher end of last month's candle. We're not below that 50% level yet. And this doesn't look very bearish yet. This is also one of the names that hasn't really crashed and burned yet. So when we're looking for, other names to get into for some shorts, this one is still on the list. It really hasn't broke down compared to a lot of its peers. Just keep in mind that it might not ever get a full breakdown as opposed to say like a PayPal or Netflix or Meta, which took significant stock price reduction over the last year and a half. The mega market cap names, the strongest names, were the last bubble to pop. And they will very likely be the first to come back again. There's a little bit of an argument on that, but this isn't the forum for that. Either way, it started with a small tech or a small market cap bubbles popped, and then the mid cap, and then the large cap, and then the mega cap. And then we've had different bubbles like a real estate, wage. Now we're in an earnings cap. Cap's not the right word, but an earnings bubble. That the cost of earnings, PE ratios, that bubble needs to pop. It's the one that we're working on right now. Between fourth quarter, first quarter of next year, second quarter, we're going to expect to see more and more companies really push down that front end. There were more layoffs this morning too. Another bank had layoffs, which is kind of a check mark for anybody who's looking for the Fed to say they've reached their target. They want to cool off this smoking hot wage fight and job battle that's going on out there. Apple, the other name that has not yet crashed and burned, still sitting pretty well positioned compared to a lot of its peers. We have that rising trend line. I am on a weekly chart. So on the week, this might have felt a little rough, but we are still within last week's range. And if you look at where we were a month ago, we're still there. We haven't gone anywhere. I'm still going to make the argument that we typically say SPY is Apple and Apple is SPY, but we've seen a serious breakdown in this over the last 4 weeks, and we did not see the same breakdown in the S&P, and that's because Apple's not affecting the S&P to the downside the way that we normally would expect it to, because it's still in this range. If Apple begins to seriously break down below 133, it'll kind of be the same benchmark we were doing in the VIX, where we said if the VIX stays between 120, 20 and 25, then the S&P would stay between that 38-41 area. Well, Apple's kind of got the same dichotomy. So take it right back over into the same situation and look at it from the same point of view. As long as Apple is maintaining within that range, and we're just going to say it's that really big green candle week. As long as we're maintaining inside of that, then Apple really isn't breaking down. And it needs to really break down if it's going to take the S&P with it. Too many times it's cried wolf, right? And we didn't get the breakdown that everybody thought it was going to be, because we're all looking at this thing to be the start of the capitulation that we need to call the bottom and come up out of this bear market. We haven't had capitulation. We haven't had the fear. We haven't had the big breakdown. Apple's supposed to be that trigger. Well, it kept crying wolf. There's the big drop. No, just kidding. Oh, there's the big drop. Haha, just kidding. People get tired of playing the game. So it needs to really begin a breakdown that people can start to believe. Then we're going to see the S&P go with it. I honestly believe that until then, as long as it's staying range bound, the S&P might take some weight against its order flow, but not enough to really drive us down into some 37, 36, 3,500 area. So Apple is the big dog. It is the general. But right now, people are flipping the dog, the bird. So, yeah. Still keep your eye on Apple. Watch the order flow. If you have Thinkorswim, you have access to that for free. It is provided for free with your Bookmap. You don't need a subscription to see Microsoft, Apple, and the ES. Bonds are still doing really good. Nice recovery yesterday. I missed it. I was a little grumpy with myself after that one. We had a really nice wedge breakout on the day. We're talking about that rotation, and we were looking at everything, wondering, say, like yesterday in the morning briefing, where was the move, right? There was like no flow yesterday. Everything was just compressed, and it didn't look like we had anything going on. But it's really a perspective of looking around at what else is moving. And bonds are doing really good right now. I mean, they're weak this morning, true. But compared, to how it closed yesterday, compared to, say, how the S&P closed yesterday, bonds are still doing really good. The S&P has broken down below yesterday's low. We're getting that Busby right now and that nice little rejection. TLT actually started a breakout to the upside this morning. We had an inside breakout above. So when we're talking about this move to the downside in the S&P, a rising tide lifts all boats. A fading tide drops all boats. If this was continuing to go up while the S&P was going down yesterday, and we settled at structure and we did not continue to sell off, if this joins the market, we're going to have stocks and bonds moving in the same direction. We're liable to see a bigger sell-off. Remember, though, that wouldn't be rotation. That would be everything. So we'd be looking at a high correlation coefficient through the morning session. Things that are down this morning, my benchmark for how far down is at least 0.5%. KWEB is down nearly 4%. And that's the ETF we use to kind of track those China ADRs. Emerging markets is also down, which is another reflection on China, really, because it makes up the bulk of the EEM. Bitcoin is down 1%. And then we've got consumer discretionary, technology, but not finance. I know finance is down, but my benchmark is 0.5%, and we don't have that yet. 2 out of our 3 risk on sectors are down more than 0.5%, but we would want all 3. Semiconductors are down, and so is communications. And oddly enough, so is the dollar. But natural gas is up 5% this morning. Just radical changes in that thing. I feel bad for anybody who's still in that. Getting whiplash. So UNG is down below our trend line here. It was drawn on a different time frame, so the line doesn't line up perfectly, but there you go. We're still below it. We're going to be looking for at least a little bit of a rebound here, likely to, pop back up just because of how far it's fallen. But on a weekly chart, when you get this kind of rollover and then you get that gap, oh boy, that's a wrap. And we had the same thing back here, right? Except we didn't have the green candle first. We just had the rollover. And up here where we rolled over and we had that big gap, but we filled that gap on that week. We filled this gap on this week. So notice how I am pointing out that even though we had that drop down, we still rallied back up to get the gap closed. We still rallied up here to get the gap closed and then continued the fall. So sure, we're falling. Yes, there's a big gap. Yes, it's very likely to get filled. Yeah, it's a monster. It's certainly something to keep your eye on, especially what's happening on the East Coast right now. So this is a part of the whole inflationary picture, and it matters. Just set that on the table. It matters. But the fact that it's going down is a good thing in the grand scheme of things. Something to continue to watch. We're still up on the year. And with this level broken, $14.30 or $14.50. Yeah, $14.50 is going to be our target. Just realize that we're at the what I call the warning center. I use the word center because it's in the middle of these two, and it is a warning area. What we often see when you've got a fib is we'll see price break out of a level at above that 100. And if it's going to fail, it will stall at that warning center and collapse back in again. It will fail to get above the 111. If it makes it through the other side of it, then we almost always make it up to the 1236. Well, we're there now. We're at the 111 today. We could wick down, and I'm on a weekly chart, so that matters too. We could wick down through that level and come right back up above it, never having reached the 1236 at all, and beginning that move back up to get the gap closed. So we're at the warning center. The 10-year is up and the dollar is down. And the VIX is up. So this is kind of broken. It shows why we keep stressing to everybody, please be careful. I hear from new traders every day, hey, can you point me to something to trade? Can I get in this? What about this? You can, but there's a lot of broken tools right now. There's divergence in the tools that we use that are screaming warnings across the board. You're not supposed to have 10-year yields up in the morning with the VIX up in the morning and the dollar down. But on the other side of that, when you do have the 10-year up and you do have the VIX up, you should see the S&P down. So from that point of view, that's still working. That's just fine. So just take that dollar, set it aside, kind of keep your eye on it a little bit through the day, but don't lean on it like we have been all year, because it's not going to be effective and it's not going to be useful and helpful right now. The move down in the dollar continues to assist with that move down in US dollar Japan. US dollar Japan moving to the downside should assist gold and silver moving up. So those should still be in play. All right, there's our gold. It's not up much, but it is up on the morning. I'd expect to see silver in there too. Probably just not catching flow yet. But a continued move to the downside in US dollar Japan should offer that opportunity for gold, gold miners, silver. And after the just beat down in energy, we're seeing a little bit of XLE turnaround. Talk about a name or an industry or a space that is ready for a short. I wrote about this on the website a while back, how we were getting into this kind of a cup and how we could get a handle. We also have a Busby now. After having broke through this range, we've rolled over, we get our Busby. Just keep in mind, the Busby only owes us back to the top. It doesn't owe us anything more than that. Generally speaking, however, the Busby is usually the start of a new trend, or if you go back and find trends, you'll almost always find that there was a Busby at the start of it all. So here where we set a high, we pulled back, we broke out of that pivot point, rolled over, got our Busby, and away we went. Here we set a restrictive level, broke out of it, came back like we were going to get a Busby, and failed miserably. So just because you get that breakout and rollover doesn't mean it's actually going to bounce. Same thing here now. We're there. We expect the bounce for the Busby, expect to move up, but it doesn't have to bounce. And if you notice, ExxonMobil's chart looks very, very similar. Or Chevron. But you can kind of go down the list and start to break them up. I do have those shared charts of the sectors, right? Where you can go in to say XLE. And these are the names that make up the weight of that ETF. Or XOP, oil and gas. These are the names that make up the weight of that ETF. I think it's going to be finance and energy again, which has been a lot of my trades on the intraday this year. That's what it's looking like for this morning. This is going to get really busy, and I apologize. I know I've heard back from some people who say, quit using that chart. It hurts. Sorry. This is a lot of names. I get it. It's a lot to take in all at once. But there's a method to the madness. We're not trying to necessarily read every one of these, more of trying to get an idea of anything that stands out. And any kind of particular pattern, like skew, for an example. We hadn't really touched on it, but we have this massive draw there in skew. Right, we got back up from below the critical level, and then we just had this massive bar, and then it sold back off again. We're in below the 50% level. It stands out. It's easy to see. We can absorb a lot on this. So 30-year bonds pressing against the top. The 10-year, not so much, right? Kind of stuck mid-size. So the front end of the curve, because we got the 5-year, the 10-year, and the 30-year all right here together. The 5 and the 10 look very similar. The 30-year kind of stands out. That's the back end of the curve. We've got that expectation that if this is the curve and you start to bring that front end up, that the back end also has to come up. And if it doesn't come up fast enough, what happens to the curve is it starts to look like that, and you get an inverted yield curve. We've seen that front end continuing to go up. You look at IRX, right? So IRX is finally starting to stall out a little bit. That quits going up so fast, and it allows that back end to come up. You're basically looking at this whole thing moving higher, but each iteration higher, the back end isn't so low down. One of these days, I'll record a video on stockcharts.com because they have an animated version of that where it'll look back at the curve over the time frame you set, 1 year, 5 years, 20 years, and you can see where every time that front end went up, the back end had to come up with it at some point. Well, we're seeing that now, that back end coming up. We're going to continue to expect the front end to go down, but not necessarily like a trade. You don't want to short the front end. You just want to expect that the front end is going to quit going up and allow that back end to rise. There's some opportunity there. Trading against the front end rising up higher. Maybe like a call credit spread or something. Gold volatility is up. Continue to expect a move in that as long as US dollar Japan continues to fade off. Bond volatility is up. We recognize that with a rise in the TLT. Ten-year yields are coming down into a critical level of support. If they bounce there, catch support, and begin to run to the upside, we could start to see the ramifications of that, which would still be S&P back down around that 3,800 level. And Bitcoin topped out and is beginning to roll over. Crude found support. Finance continues to break down. It's still tech versus finance at the moment instead of tech and finance. All right, so we got a head and shoulders on the 1 hour. We literally have all three, left head and right shoulder. We're going to be looking for a neckline break. It is a 1 hour head and shoulders, so approach it with a little bit of caution. It doesn't have to follow through, but the measured move would put us back up to around 35, maybe 35 and a quarter, 35 half. That's a nice little play if we can get that neckline. Yeah, 35.2. So it's up to a monthly level. I got a monthly line at 35.18. It's close enough. We do have a gap to fill. I do this a little bit differently. A lot of people will say the gap is filled if we get back inside of this candle. I argue that we closed down here. It won't be closed until we get back down to that spot. If we closed here and we opened here, that created the gap. We need to get all the way back down to 33.87 to call that gap closed. Other technicians will say we're closed as soon as we get at least to the open, or even just inside that candle at all. They'll consider it closed. I'm not saying I'm right and they're wrong. I'm just saying, we can do it different ways. That's the way that I do it. So we've got a gap that will create its own magnet. If we do get back below or even close to 34, we're going to start to gravitate to that 33. We have a TRB, which I don't normally run from the upside, but there's our trend line, solidly broken. We got every expectation that we're going to go back down and reset the box. Just like we did here, where we ran up and we had that little fake out. Don't feel like you're missing the boat and that you have to jump in. We've got FOMC, PPI, CPI. There's no reason to jump in yet. And this little bit right there is enough to kill your trade. So give it at least Friday, where we get our first of the 3 major econ, because this is a weekly chart and we're not going to go from here to here this week. You're fine. You're not going to miss it. Give it a chance to the end of the week to see how this weekly candle closes and to get one of the first 3 data points that we're looking for. If you're looking to day trade, hey, no problem. But we're talking swing, just looking for like a short duration play. Generally speaking, XLF is not, a big runner. Yeah, it's got a 1.5% ADR. That's 52 pennies. So on a day-to-day basis, this thing, moves less than half a dollar. Plenty of time. No reason to jump the gun and run and get into it too soon. All right, we're looking at the S&P 500 because they don't offer an S&P 100. So we're going to use the filter, knock it down by market cap. Try to get close to 100 names. 101 is close enough. Set it to pre-market change percent. Notice there's a lot of gray in there. That's because it won't change for us until these names get to a minus 0.5. Well, we can change that. We come up to where it says times 1 and turn that into a decimal number, 0.3. Now it's more responsive. So we just changed the color scheme, right? That's all we really did there. The heat map is not as useless as it first appears. These really big names, those are your monsters of tech. So Apple, Microsoft, Google, Amazon. The size of the market cap changes. And so the size of the box changes. The names in the acronym for the FANGs changed. But at the end of the day, if you bring up a map like this, you can still see who the big dogs are. Tesla's down nearly 3% this morning. Apple's down 1.25%. Microsoft 1%. So some of these big dogs are down considerably. Google, Facebook. We can also start to see where a little bit of the money is flowing. Like Disney's up this morning. ConocoPhillips is up a little bit this morning. Financials are getting nothing. A lot of these are flat. If finance starts to join tech, we're going to see a rout. That would be bonds moving down, finance moving down, tech moving down. If we start to get energy moving down as well, then we have that high correlation coefficient, 99 out of 100 names all doing the same thing at the same time. Let's change this over to the NASDAQ 100. We don't need a filter for this. It's already 100 names. We just change the color scheme. Again, the big names stand out. So let's put a number behind it for the correlation. How many names in the S&P are down 0.5%? 40. That's not very bearish. How many names in the NASDAQ are down 0.5%? Oh, that's positive percent. Let's go negative. 44. Again, that's not very bearish. So it might feel really negative out there. This argues that we're not down a lot. We're only down some. 44%, that's, yeah, it's a little bit, right? So let's take it to the extreme. How many names in the NASDAQ are down at least 1%? 19. Again, that's a low number. So don't get overly bared up this morning. Approach with caution. Let this market start to, provide some insight as we come into the open. And it's not going to be just the big dogs. It's not going to be just the monsters of tech. Keep your eye on the rising tide or the lack of a rising tide, right? Watching all names fade out together. We want to see energy fall. We want to see bonds fall if we're going to really get that route to the downside. Without it, any one of those could provide enough lift to, we would still see a down day, but it would be kind of like yesterday where we didn't just crash and burn. We had stability and market structure. See the financials yesterday. Sure, I mean, they're down. They were down some, but they still managed to get around VWAP by the end of the day. And it wasn't just an absolute rout. Same with mega tech. TLT right back up again. So we still got bonds making that move to the upside. Inside day breakout upwards. We're going to expect to see bonds continuing that rise on the back end. Everybody be careful, be safe. Have a good morning. I will see you all tomorrow.